maybe it's a 60-40 stock bond portfolio. You don't understand the concept, but you buy into it. You put money in there. So this is really simply a due diligence event where we've invited some people that I have done due diligence with over the last 2 years. So I met Dave on, I looked at my calendar, December the 5th of 2017. I started my due diligence on Western Wealth Capital. For 2 years, I've done due diligence. I have been to 2 events, one in Phoenix, one in Dallas, over the last year, to actually look at some of the properties they've done, really deep dive into the opportunity to make sure that we're comfortable. So, for those of you who don't know me, I'm Bob Simpson. I am Director of Private Debt and Equity for Wealth Stewards. I just joined the firm in the last 6 months. Although I've known Paul and Peggy Tyers for 20 years. They were actually a consulting client. My background is that I was an advisor in the 80s with Nesbitt Thompson. I was a senior manager, as well as I was manager of fixed income strategy for a company called Midland Wallen back in the 90s. Managed money for an insurance company, and for the last 22 years, I've been a consultant to financial advisors on both portfolio management and practice management. So that's kind of my background. So my role now is to identify opportunities, do the due diligence, and then educate people on those opportunities. So tonight we've invited Dave Steele and Tim McCleary from Western Wealth Capital. They're in from Vancouver. And we grabbed the opportunity to get some time with them this evening. And they're going to take you through the concept. That's all they're here to do tonight. If you have any questions, speak up. The presentation will be about 45 minutes. At the end of 45 minutes, there'll be 15 minutes of questions, open for that. But, Dave's pretty good on his feet, and I think if you want to interrupt him with a question, he's going to be wide open to that. So without further ado, I want to introduce Dave Steele, and thanks for coming up. Appreciate it.
How's everyone doing? I'm going to talk a little bit about what's called value-add multifamily tonight, and I'm going to talk about why we love investing in U.S. real estate. But before I get that, what I'm really going to talk about is retirement, because this is what it's really all about, right? Why are we really here? Because we're trying to figure out, what do we do with our money? Because, people say to me, well, Dave, I've got very, very clear goals on my retirement. Someone said, my dream when I retire with my savings is living on a small island somewhere. And I said, you come to a seminar like this, if you write that down and you're not really clear with what you wrote down, you might end up with something like this. Right? You wrote down, I'm going to live on a small island somewhere. Hopefully it's not Kingman Bay. So, I started out with nothing, and I still have most of it, so that's my retirement. They also said, the Bank of Montreal did a survey about 20 years ago, and they surveyed people, and they said 6 out of 10 Canadians plan to retire by winning the lottery. Okay? So, then I saw this slide, which I really like. I won $2 in the Mega Millions. Please respect our privacy as our family decides how to move forward in this exciting and pivotal moment in time. So I've never even won $2 in the lottery. But I did just turn 60, and this is actually quite true. I always knew I'd get old. How fast it happened was a bit of a surprise. At my 60th birthday, I said, the craziest thing was my whole life, whenever I knew someone that was 60, they were always like friends of my parents, right? Now it's like I have friends that are 60. And one of my buddies standing in the room, I go, God, I even have a friend that's 70. I can't believe that. He didn't like that. And then the other thing is we're trying to figure out how do we get this balance of putting our money to work so that we have to work a little bit less, right? Because I'm sure we've all dealt with this. Oh my God, tomorrow's Monday again. I don't think I can do this every week, right? So, how do we do this? So, I've been in the real estate business for 30 years. We've bought and sold about 20,000 apartment units in the last 30 years. About 6 years ago, I met a gal by the name of Janet LePage. She was 30 years old. She'd been flipping houses down in Phoenix. And she came up to me and she said, I've got this apartment building tied up in Phoenix. I need to raise $300,000 to buy it. What do you think? And I sat down and said, well, this is an amazing deal. I said, I'll give you the money. And she called me back that night at home and she said, She said, look, I don't want just you to invest in this. I want you to bring in at least 2 other friends, because you're gonna make so much money on this deal that when you do, the next time I have a deal, I wanna be able to introduce it to you and your 2 friends. And I thought, man, that's pretty cocky, right? Here I told her I was gonna give her the money, and she calls me basically to tell me she didn't want my money. So we got 2 buddies, we bought the building, we made 50% a year on our money, we renovated it through the value add I'll talk about tonight, and that was the first deal. And that was 68 properties ago. So in 6 years, just over 5.5 years, we've bought 68 properties. We've bought and sold almost $2 billion worth of real estate. And as boring as it's going to sound when you finish tonight, we do the same thing over and over and over again. The process is we do the same 52 things that we do to a building, and we do them very, very fast, and that's how our investors have been able to make money. So of the 68 buildings we've bought, refurbished, and sold 30 of them. And of the 30 that we've sold, our investors have had an average annual return of 30%, okay? So I didn't hear a wow. There should just be a little wow, right? Because if you're getting 30% on your money, honestly, you don't need to sit through the rest of tonight. And if someone comes here and stands in front of you and says, hey, I can get you 30% on your money and it's really easy, you should run out the door, because it's not really easy. I've been doing this for 30 years in the real estate business, and this is a formula that's a very cool formula because it's so repeatable. And it's repeatable because it's not really tied to just picking the best markets. It's tied to forcing the appreciation of a building by doing certain things to it, which I'll talk about tonight. So the first thing starts is, why would you invest in the US, right? The first starting point is that between now and 2030, the US needs 328,000 new apartment units a year, right? A year. So they need 4.6 new apartments are needed, right? Now, obviously, that doesn't mean you can pick any city in the US and you're going to do well, but there's clearly some cities that are going to be winners. There's clearly some cities that are going to be not winners. And if you look at what's happened with the annual construction rate, you can see that the construction has not kept up with what's required, and nor is it expected to. So there's a big demand, there's people building new construction, but there's also this real opportunity to buy what I'll call, as very simplified, a 1985 building that's in need of repair, and I'll talk to you about that for a second. So we look for the markets where this imbalance exists, and we go in and we target these 1985 buildings. So where's the market? The market starts very simple. Anybody got any idea what a 2-bedroom apartment in San Francisco rents for today?
$6 grand.
$6 grand, $4,000, about $4,200. Okay. So if I'm Apple, American, unfortunately, yeah. 6,000 Canadian. There you go. Yeah. So if I'm Apple, Intel, Google, one of these companies in San Francisco, and I'm hiring someone, and the average rent is $4,200. I'm paying them a lot of money because they have a high standard of living. So what's happening is all of these companies are going to about a dozen markets in the US where they're moving regional offices to, because they can hire people for a lot cheaper because they have a lower standard of living. So what we do is we target those cities, and we look at those cities where those companies are moving to, and then we target the housing supply in those markets. So the first thing we're really driving is, where are the jobs getting created? Because if the jobs are getting created there, there's people moving there. Little statistic is there's about 100,000 people a year right now moving into Phoenix. There's about 1,000 people a day moving into Texas. So right now, Texas is a big growth market. 1,000 people a day are moving all over the US into Texas for the jobs. So we identify the top markets, where are people moving to. Again, we're trying to focus on the markets that we think are in the top 10 or the top 15 markets. Why? Because if I pick Omaha, Nebraska, and it's market number 62 in the US and something changes, it's going to become market number 100 in the US. I don't want to be in market number 100. I want to be in a market that if things change, maybe it's not in the top 2 or 3, maybe it moves to number 6 or 7. So if you look at it here, you can see the markets: Dallas, Houston, Atlanta, Phoenix, Riverside, Orlando, Austin, a lot of markets, and then I'll talk to you about the affordability matrix between those markets. So the result is, what does that then mean to, if you've got the job growth, it's pretty easy to see that right after that, the population growth follows. So we're looking for the markets where the population growth is following. So here's an example of Dallas, one of the markets that we currently own a bunch of properties in and we really like. 7.2 million people, super low unemployment rate, median income is about 72,000, and it has the #3 highest concentration of Fortune 500 companies in the US. So again, market that fits us. Same with Houston, 6.8 million people. Again, low median income, 68,000. It's the 4th largest population in the US, and it has the largest medical complex in the world. Same with Phoenix, again, 100,000 people, #1 fastest growing city in the US. So you kind of get the theme, right? Like there's markets that we really, really like, and I call that the tailwind, right? If you get behind the tailwind and there's lots of people moving there, you can look pretty smart in real estate because the jobs are getting created, the people are happening. So then we look for where we can get rent increases and where we can get affordability. So there's a really cool website, if you go on, it's called cnnmoney.com. You can pick any city in the US, you can type in what you would have to earn in that city. So here, if I live in San Francisco and I want to live in Texas, I currently make $150,000. I can have the same standard of living in Dallas, Texas for $79,000. And I will tell you, this is what the Apples, the Intels, the Googles, the Amazons, this is exactly what they're doing, and that's why they're relocating to these markets. Same thing, Houston, I can relocate there, $76,000. Phoenix, about $74,000, right? And so if you look at it, the real driver is the share of income right now in LA, San Francisco, and Miami is it's between 42 and 45% of people's employment income is being spent on housing, and we're targeting cities and markets where it's between 27 and 30%, okay? So those are so what we really look for, start at the absolute top of the funnel. How do we get the 12 markets we like? We get the markets because they're being driven by job growth, population growth, and then I'll kind of work our way down. So these are the markets we like. We're in 5 of these markets right now: Phoenix, Houston, San Antonio, Atlanta, and Dallas. We're the 2nd largest multifamily apartment owner right now in Phoenix. And these are the other markets. So part of the advantage of having an active acquisition team in so many markets is we're not trying to buy every deal in every market. We look at 10 or 15 deals a month in each one of those markets, and we're really looking for the 2 or 3 deals a month in the markets where the owners typically aren't getting along. They're fighting over who they got to put more cash into the deal, or they're fighting over getting a bank loan. And so that's where we go in. We look and try to find those deals that we can buy in the market. So if we've got a dozen markets that we like, we go into those markets and try to find the properties where there's a bit of hair on the deal and we can buy the deal. So this is where we've acquired the 68 properties. And then we go into the micro markets, right? So again, here's the overview of Dallas. Because the key thing is, no different than Toronto. There's markets in Toronto you'd really like. There's markets in Toronto you wouldn't like. Same in every market. So with us, there's markets in Dallas. There's sub-markets that we really like. Arlington, as an example, has 260,000 jobs within a 25-mile radius. These are all the Fortune 500 companies that are nearby. So it's very easy to target, see those companies, see which ones are hiring, see which ones are moving people there. McKesson, just 80,000 employees, just opened a headquarters in Dallas, in this area in Arlington. We really like being near airports because there's a certain other level of screening that your tenants have to go through if they work at the airport. So that's an area whenever we can find properties near the airport where the tenant base is at the airport, we really like that. Universities are big for us. So really we start at the top, what's the markets we want to be, and then we drill down into the lower declining markets. So show of hands, who here has owned or owns any multifamily real estate? Okay, a couple, great, thank you. So the way it's valued is you take the net income of a building, you divide it by the cap rate in the building, and that's how you get the value of the building. So I'm not going to go into a long explanation, but that's how it is. And so what we try to do is we try to radically improve the net operating income. And One of the things that we're certainly seeing today that I think is going to be a big, big boost for the multifamily business in the next 5 years in the US is there's this constant pressure on interest rates to keep coming down. There's so much money pouring in, there's so much capital available right now coming from the rest of the world that it's certainly having an effect on the rest of the world, not as much in Canada and the US, but a big reason why we think interest rates are going to come down. So from our standpoint, if we can increase that income, that's how we increase the value of the building. So very simple part of our model. We go in and we try to buy a 1985 building. In a perfect world for us, if that building has 300 units, we call those classics. Now a classic unit for us is you walk inside, it's got that old carpet, it's got the turquoise toilet, and it's the kind of place that you would look at and probably say, I would not want to rent here. It rents for, say, $800 a month. When we're finished, that unit looks like this. This is called our Gold Star. We spend about $6,000 to do this Gold Star renovation. We do the same thing on every unit. We renovate the unit exactly the same way, whether it's Dallas, Houston, San Antonio, or Phoenix. We use the same towel bars, the same toilets, the same stainless steel appliances. And when we started in the business 5 years ago, we could renovate a unit in 28 days. We can now renovate a unit in 8 days. So the whole thing is, how do you keep doing it and how do you do it fast? So what does $125 a month mean in our world? Well, there's what the unit looks like on the day we buy it. When we renovate the unit, we know we're going to get $125 a month more, and I'll explain to you kind of how we know that. So $125 times 12, and if we get 200 of the 300 units, if we can renovate them, that means we can increase the net operating income by $300,000. If we can put a washer dryer in, because most of these have laundry rooms, so we go and we start selling the washer dryers door to door, we get another $40 per month. $40 times 12 times 200 units is another $96,000. So in our case, we get additional income of $396,000. If we are trading in a market, and most of the markets we're trading in, we trade at what's called a 5 cap rate, that increased net operating income means that the value of the building goes up by just about $8 million, right? So from us, people say, well, geez, you pick a good market and the property will go up in value. No, we pick a market where if we can do 200 Gold Star renovations and 200 washer dryers, we can make that building worth another $8 million. Now, how fast can we do it? If we can get it down to 8 days, if we can do, instead of doing 4 a month, we can do 8 or 10 a month, then it's just how quick you can turn the wheel to be able to do that, right? So this is really the model that has worked for 68 deals, the same thing over and over. And then you look and you say, what happens if the interest rates fall? So if you get a drop in the interest rates, which many people expect, you're going to get a corresponding drop in the cap rate on these buildings. So that means overall buildings in this area will trade at a lower cap rate. So that means if you're suddenly trading buildings instead of a 5 cap, you're trading at a 4.5 cap, that $7.9 million worth of value now becomes $8.8 million. So doing nothing different, your value increase suddenly becomes $1 million more. And people say, well, Dave, why is this happening? I'll show you that in a couple slides. Here's really why it's happening. We're kind of right in here with the United States. If I want to go and get a 10-year mortgage today, it's about 3.5% on a 10-year mortgage. Now go and look at the other countries. If I want to go to Britain, I can get a 10-year mortgage today in Britain at 0.75%. Okay?
I have friends paying to put the money in the bank.
Well, that's the next slide. Yeah, that's the next slide. So, in Europe today, there's, I quoted 14 trillion in a talk I gave last week. There's $14 trillion of cash sitting in banks in Switzerland that are paying interest to the bank to hold on to their money. Okay? $14 trillion. So you look and you say, what's happening? This money is pouring, and that's part of why the money's coming to Canada, but also a big part of why the money's coming into the U.S. and into multifamily, is people are looking for a safe place to put their money. But my belief, and I leave this to every person in the room to go figure out on their own and decide, but if the rest of the world, if the Germanys of the world are charging 0.5% interest for a 10-year mortgage, how long can we sustain the kind of interest rates that we're paying in Canada and the kind of interest rates we're paying in the United States, you know, that's why the money's coming over here. And any guesses on Denmark, what the 10-year mortgage rate in Denmark is?
Zero. They give you money.
Yeah, negative 0.5. If you pay an upfront fee on a 10-year mortgage, they will give you 0.5% on your mortgage payment every month. Okay? So again, what is it? People have all this cash. They want to park the cash somewhere and know that it's safe. So, you know, again, you know, I think that's going to have a thing. So from our perspective, you know, we look at it right now as the perfect storm because, you know, one of the big advantages, we just bought a building. We paid $21 million for it 2 years ago. We did the renovations. We did 10 units a month on the Gold Star renovations. We put in the washer dryer. We drove up the value of the rent. Now here's the craziest part of the whole program is that in the United States, when I go and buy a building for $30 million, the lender gives me a loan day one for $30 million. Okay? Now they don't lend me $30 million, but they approve me for a $30 million loan. So I raise $10 million of equity from the investors, and I get a $20 million loan. At the end of 2 years, when the building is worth $30 million, because it's gone from 20 million to 30 million, so it's gone from 30 million to 40 million, at the point that it's gone up in value, they will lend me 75% of the increase in that value. They'll just increase the loan to that amount. We're then able to pull that money out and give it back to our investors. So most of the investors that have participated with us have seen 50% of the return of their capital at the end of year 2, 70% of their money back at the end of year 3, and 100% of their money back at the end of year 4. And they still own the building, and they're still getting 4 or 5% annual return on the money they no longer have invested. Okay? So does that make sense? Did I zip through that pretty fast? Because if I did, I'm certainly at the end, I'm happy to open it up. But that's, so if you really look at it, it's almost like the banks in Canada, they'll give us a line of credit against our house. That's exactly what they're doing. And you say, well, why would the banks do that? Because what was happening is they were lending us the money when the building was worth 30 million, which in their mind was the riskiest time to lend us the money. And then all of a sudden when the building's worth 40 million, and all the suites are renovated and the leasing office is done and the building is cash flowing and it's really good, we would have to take that building and go get another loan with another lender. So they said, this is crazy, we don't want to lose that business. So they built the loan in day one where they were giving us the financing right out of the gate. So what we try to do is in our business, we call it the need for speed, right? Because if the goal is I have to renovate 200 units and I have to put in 200 washers and dryers, and I know that if I do that, I make 100% for the investors on their money, then the only question is, it's a big difference if I can do that in 2.5 years or 5 years, right? I can make that much time faster. So our model that we've really worked on perfecting is we call it the need for speed, because when we got into the multifamily business, this is what the business was like. Everything about the multifamily business, everything about getting the loans and renovating the suites and doing everything, this was the speed that the business operated at. And off it went, right? So we said, okay, how do we do this, right? So this was a building that we just bought. This is an example of a suite that was renovated. So we said to our team, can you do it that fast? And they said no. And so we said, okay, how do we get it from 28 days down to 8 days? How do we start doing 10 a month versus 4 a month? And how do we do that? Well, we also maintain 93% occupancy on the building, because you don't want to take your building down to 75, 80% occupancy, then you have no cash flow at the end of the year. So it's about how you renovate and how you keep it going, and also how do you do it where when you're busy times of the year, because it's like everywhere, in September, I could rent 100 units. In December and January, I don't want to turn over any units because no one wants to move on December 31st. So how do you balance it seasonally, and how do you build this renovation plan where you can do it over this speed, right? So what we did is we established what we called the WOW Factor program. And the WOW Factor was, we realized that every single building that we got into, every color of every building, we were sitting in a design meeting where the designers were saying, well, we should paint this one red, we should paint this one blue, we should paint this one green, here's the signage package. And we thought, you know what, McDonald's doesn't have a different color building every time, it doesn't. So we literally came up with 3 or 4 color schemes and 3 or 4 designs for the building. And now when we take over a building, the day we put the deal under contract, we choose the name, we pick the signage package, we design the website, and the day we take over the building, the day that we close on the deal, 75% of all that stuff is done. Because the impact for the tenant is, on the day we take over the building, we want to have a big wine and cheese, we want to bring in food trucks, we want to introduce them to the building, we want to start showing them the renovated suite so they can start making a decision to upgrade and who wants to get the renovated suite. So we went through this whole process that became our 52-point checklist. So, and then we got into a whole program of here's all the contracts that we needed to sign before we took over the building, because most people in our industry design this where they close on the building and then they go to work to start meeting the painter and meeting the roofing company and talking about what they're going to do with the pool furniture. We want the pool furniture delivered and put around the pool the day we own the building. So we do all this work now during our due diligence period.
So Dave, I heard a story, you had a problem with the police at one of your buildings recently, right?
Yeah, because we showed up, the operations team showed up at 11 o'clock in the morning to start putting furniture and everything else, and the owner called the police because it hadn't closed by then, it only closed at 1 o'clock. So they said, look, you guys have jumped the gun here, so yeah, so.
Can I clarify something before we go any further? So you're not changing tenants? Sorry, maybe I should.
No, so
you're just, and do they have the option to upgrade or not really?
So 120 unit building, in a perfect world, you want 10 units a month renewing every single month, right?
Okay.
Except you don't want any in December, you don't want any in
Okay.
January, you want a bunch more in March, in August and September. So the first thing you want to do is you want to get the lease aligned around exactly when they renew.
And when you become new owners, you have that legal right to do that?
Legal right to do. So I turn around now on December and I say, would you like to renew your lease, Norm? And you say, absolutely. I said, we have 2 options. You can renew on a 10-month or a 14-month lease. We don't have a 12-month lease that renews anymore on December 31st. So we renew for you earlier or later. Now, depending on how many units we want to get turning over, and so let's say we say, I want 15 units vacant this month because I want to get my renovation plan. Then I decide that month whether I give you a $25, a $50, a $75, a $100, or $150 rent increase. If I want everybody to move out, like 2 months ago on one of the buildings, we wanted everybody to move out, so we gave everybody a $200 rent increase. Nobody moved out, they all accepted the rent increases because they liked the community. So they didn't pay the $200 to renovate the unit, they signed to another 12-month lease.
Wow.
Now, it wasn't great, it was great for us, but we want the units free so that we can renovate them. So there's a bit of an art and a science to, so what you really want to do is you want to manage your renewals and you want to manage turning the units and then bringing new people in at the same time.
So, point of clarity, in the markets that you go into in the US, which is very different than up here in Canada.
Correct.
Very different.
There's no rent control.
No rent controls. Land of the free, home of the brave.
But to they do get right at first offer. In other words, the example you're highlighting, they are given the opportunity to stay in their unit.
So there's great comment. In 99% of the cases, that's correct. We do have situations where we know we're going to have to give such a big rent increase that we just tell people we're not renewing because we're going to renovate the suite. Because let's say I have to give you a $400 rent increase to move you out. I don't want that to become the talk of the whole community. I'd rather just give you the notice, you have to move out, I go in and I renovate the suites, rather than give you such a big rent increase to get you out. Because then that becomes the buzz in the whole community, and then at that point, you're just not a good landlord. So the theory that I believe is that people don't mind paying more rent. What they don't like doing is they don't like paying more rent on the promise that you're gonna fix up the building. So our whole premise is we go in and do all this stuff on takeover day, and then when they literally leave for work in the morning, when they come home in that afternoon, it's like they've come home to a brand new community. That's how significant it is. And then over the next 90 days, we redo the leasing office, we paint the building, we reline the parking lot, we put up signage, and all of a sudden you take a building that's $800 a month rent on average, that most people wouldn't let their kids, their college kids, stay in if they went to that city to go to college. And when we're finished, you would gladly let your kids go there to college, you'd be happy. And when McKesson moves in down the street and they've got 4,000 new employees, the executives are gonna go rent the brand new $2,500 two-bedroom, and all the other employees are gonna come and rent the $1,100 fully renovated Gold Star.
To understand this in a different way, assuming you did nothing and just the natural rate of turnover that you're noting in these markets that you're entering into, it's about 25%?
About 17%. It's about a 17% turnover that we get. And so, again, there's so many things I could dive into, but in our world, the leasing office, leasing is the least sales job in the world. Like leasing in most buildings in the US, people that own apartment buildings, they're order takers. They don't sell. We go in, we train the sales team, we incentivize them, we get things going, and then we really get them motivated to sell washer dryers, sell Gold Star renovations. Hey, Unit 207 is being renovated. Would you like to see it? It's going to be ready on November 15th. Would you like to move from your unit into that unit on November 15th? Absolutely. We move them around, then we renovate that unit, and you just keep turning the wheel.
So it's all good except for the people that can't afford a rent increase.
Correct. So again, we're in the B space moving to B plus in most cases. So the same thing is happening in the C space moving to C plus. So those people are migrating typically to the C plus buildings, right? So again, we go in, this is what we've standardized the models. So every time we do a model suite in one of these, we do the same thing. We standardize the leasing offices, so we have a certain look and feel to the leasing offices. This is a property we just bought. This is what the clubhouse looked like on the day we took it over. This is what the clubhouse looks like after the fact. So again, if you think about it, you're walking into, I liken it to the way motels used to be beside airports. They were $69. Nobody ever wanted to stay at one. They were really crappy motels. Then all of a sudden they put in the Hampton Inns and the Holiday Inn Expresses, and now they're $179, and everybody has no problem staying there. So that's really what our focus is. And now our next step is how do we do it faster? So if you look at it, these are all the things that happen in the timeline. So 120 days office out after someone buys it. They acquire it. On takeover, they start to write the marketing plan. They start to talk to the company about the website. Then 30 days afterwards, they do a show suite to tell people that they're going to renovate. So what we really try to do is we try to take all of that and push it further and further closer, because again, the faster we can do this, the faster I can reappraise the building, the faster I can reappraise the building, the faster I can get you back 50, 75, 100% of your capital. And of course, what happens is the investors go, this is fantastic. And we do about 10 or 12 of these deals a year. So people say, hey Dave, we really like this. Put me in for X number of dollars across 4 deals, across 8 deals, across 10 deals, whatever it is. And then people invest in them. And then over time, they just start turning their capital through the refinances, which they're then able to use again. So now the next thing is taking everything that we've done. This is our big goal for 2019, is to take everything and push it even further left and do it even faster. So it really just comes down. And the other thing that's really cool is now in all these markets, we own so many buildings in all the neighborhoods, right? And I tell people, like if this was the stock market, we just have all the insider information. People, when I say, hey, how do I know I'm going to get $125 rent? Well, because I own every building in that neighborhood. I see the rent chart every single day of what rented. I see what a classic unit rented for, what a Gold Star rented for, right? So So, here's a property in Phoenix. Here's the last 10 units that rented. So I turn around and I go, hey, I'm looking at buying another building. I know that on average, we're seeing $170 rent increase across that building. And it's kind of, if it wasn't real estate, it was stocks, we'd be insider trading, but that's another story, right? And then you look at innovation. So here's a really cool one. Anybody here have live here in a condo or an apartment building with parcel lockers?
I know.
Yeah? Yeah. So we started doing this, and the way it works, the way it typically works to date is, if you live in unit 101 and there's a parcel that comes from Amazon for you, they go to the front desk at the leasing office, there's a clubhouse, and they hand the parcel to the leasing person, and they put it behind their desk. And 4 o'clock in the afternoon, when all the residents come in, there's just a big stack of boxes, which the property management company has the liability for all day, right? So they finally said, hey, this is crazy, we don't want this liability. So they put in these parcel lockers. And what happens is when you get the parcel delivered, we set up a little room, the parcel lockers are there, and you get a text that says, your stuff's in locker 22, your parcel from Amazon's in locker 22. When you get there, just type in code 6262, you type it in, the locker pops open, you get your parcel, okay? So in our world, that's on average $9 per resident per month. So 300 unit building, $9. Anybody want to take a wild guess what this adds to the value of a building?
Oh, on the 8 million that you're already making?
Yeah, over and above the 8 million.
No.
So it's $540,000 the day we put the parcel locker in and everybody starts paying us $9 more a month, right?
I believe you.
So how do you, not everyone uses Amazon, so how do you charge people who aren't using it?
Everyone has to have it. The only reason you wouldn't have to have it is if you don't want any parcels delivered to you. The leasing office no longer accepts parcels. So if you have any parcels delivered to you, in today's world, I'm going to say, I think out of the last 2 buildings, out of 300 units, we had 296 and 297 people all sign up. So there's a couple people that are like, I'd never get a parcel, but the short answer is if you're going to get anything delivered, you have to sign up.
So they sign up, you don't just impose it upon them, you can't do that.
Yeah, no, correct. So they have an option to opt out. But again, in today's world, the millennial world, they get this. Now you look at it and you go, where's this going? Because I think as exciting as what it is. Like when I stood up here 6 months ago, the parcel lockers were like, that was the future for us. Now it's like we've got 45 buildings. We've added this to every one of the buildings. Another crazy one is we also do dog yards, okay? So we take all our ground floor units and we put a fence around the ground floor unit, and the fence costs us about $1,000, and we get $125 a month for a dog yard. So if you've got a small dog, people pay it all day long. We're then stuck with these laundry rooms, washer dryers. Once everyone gets the washer dryers in, we got nothing left to do with the laundry room. So somebody came to us and said, boy, you really want to get the people with pets, because the fact that we have dog yards puts us at the absolute top of the heap when you're looking. You have a small pet and you're looking, they look at our properties and they go, hey, dog yard, absolutely want it. Now, the math is for every $100 of rent that you get, you can multiply that by $200, and that's how much it increases the value. So a $100 rent increase is about a $20,000 increase in value. So every time we spend $1,000 on a dog yard, our property goes up by $25,000. So on the last property we did, as soon as we took it over, within 90 days, we put in 50 dog yards. The property went up by $1.2 million just with the dog yards. Then you do the parcel post, another $500,000. Now, here's the cool part is, where do you think it's going, right? Whole Foods believes that on every balcony, the drone is going to come and it's going to deliver right onto the drone. You're going to have a little thing, it's going to unlock, it's going to slide in there, right? And this was the first, March of 2017, the first autonomous drone delivered a medical part, a kidney, I think it was, in Switzerland. They got a special approval to deliver the kidney. So Amazon believes that they're going to actually have their warehouses in the sky, and so the parcels that they're going to deliver, they're just going to come down from drone or from blimps in the sky, right? Everything will be delivered in 60 minutes. And what they also believe is that not only will they deliver you the parcel that you're getting, but they'll know everything about you so well that they'll go, hey, by the way, I know you like gray jackets. We've included a second box with a gray jacket in it. If you decide you don't want the gray jacket, just leave it in the box, and in the next 2 days we'll pick it up. If you decide you do want it, we'll just charge your credit card, right? So which kind of reminded me of this. My wife asked why I spoke so softly in the house. I said I was afraid Mark Zuckerberg was listening. She laughed, I laughed, Alexa laughed. Scary but true, right? So I think, we're sitting here looking, hey, where's this going with grocery delivery? Because, the apartments and this is going to become quite a big thing. So again, the markets, this is kind of what we do on the growth, and every time we look at a deal, highest concentration of Fortune 500 companies. And then this is typically what we would look at on a business plan. So we do a webinar, we do an executive summary every time we launch a new project. So, kind of once you say, hey, I'm interested in finding out about these, we do a launch, we record the webinar. They all go out also through, they go out through Wealth Stewards, you get a copy of it, and then you get to look at each individual one, right? So you say, some people say, I don't want to invest in Houston, my ex lives in Houston, I don't like Houston, but again, the markets we're in, we really, really like. And then in almost every deal, they have the same thing, so we normalize the rents. That's how much income we're going to gain by just getting the rents to market. So we do a market survey because we know the rents, and again, we buy a lot of buildings where people don't live in town, so we know they're rented way below market. Then we look and say, how many interior upgrades can we do? How many washer dryers can we do? And we generally don't forecast doing them all. Like we'll say, we're only forecasting doing 65 or 70%, even though we've got a lot of buildings where we've done 85 or 90%. And I'll show you why in a second, because when we forecast them here with 65, 70%, they come out to be an 18, 19% annual return. If I forecast where we do 80%, they come out to be a 30% annual return. So we're not out trying to raise the money on the basis of a 30% return. We're out on the basis that these deals produce typically 18 to 20% returns, and if we can do them fast, we can increase the velocity and get a higher return over time. So again, in this case, the equity required on this deal was $29,800,000, and you can see that the total increase that we're able to get on this building right here, just from doing these four things, is about $28 million. So it's about 100% return on our equity just simply by doing those four things. And so once you see one deal and then another deal and then another deal, you really get a sense of it.
And have you actually sold units then, not just in
We've
like,
sold,
not units, pardon me, buildings?
We've sold 30 of the 68 that we've done.
And
that
who's
was,
buying them? The people that are getting minus percentages?
Yeah, so that's a really good question. Who's buying them? There's so much money right now in the institutional world with REITs, with pension funds, with family offices, large institutions, and quite frankly, they look at what we do. They're not trying to make 20% on their money. They're trying to make 12 or 13% on their money, and they're looking at it going, 3 years down the road, we've put on a new roof, we've painted the building, everything on the site is spick and span, all the units have been renovated, property's cash flowing like crazy. They get to come in, put a property manager on it, park their capital, and not have to do a lot of work on the building. So we believe there's actually a bigger demand once the buildings have been value added, because most of these large institutions, they're not really in the value add business. They're in the business, they want to know how can they put $100 or $200 million to work, not how they can buy a building like this and put.
They just want to move money around, not countertops.
That's really true.
Yeah.
That's really true. So again, here this is a 95% equity, and then you can see on this building, we increased the value of the building, and so here we would refinance by the end of year 2, almost 15 million, another 7 million in year 3, another 7 million in year 4. So in this case, if you put $100,000 in, you'd get your annual return in year 1 of 3.8, then 5.365, and you can see it drops a little bit here. In the first 3 years, the lender gives us an interest-only loan, and then year 4 and 5, they start amortizing the loan. So you're getting, you know, anywhere between, call it a 4 and a 6% annual return. And then if you put $100,000 in, you 50,000, 25, it doesn't really matter. The minimum's 25,000 US. Then you get, theoretically, you get 50%, 75, and 100% of your money back by the end of year 2, 3, and 4. And you can see that it's all driven by how much the net operating income. So we're buying this property for $73 million. You can see here's our growth. We're taking the net operating income from about $4 to almost $6 million. And over time, you know, we're taking the value. And you know, a lot of analysis people do is that they go, Dave, you know, these are great numbers. You know, what happens if you only get it? You know, what happens if you only get it to $100 million? Or 80 million or $90 million over a 2-year period. Because the thing I like is, you know, we've now done this. We have 1,200 investors that have invested with us for 6 years. You know, the investor base keeps growing, and it grows mostly because of word of mouth. About twice a year, we do a trip. We did one, as Bob said, he came on one to Phoenix, and we did another one to Dallas. Most of our investors come on the trip. And it's kind of like you get to see firsthand, here's a before, a during, and an after. So you can see a property that we're just buying, one that we've bought, one that we've owned for a couple of years. And you know, you get to see the dog yards and the parcel posts and the change and the paint and you know what it looked like. So it's really, you know, you get to really see firsthand how it all works. But you know, what I say to people is, after you know having done this for a long time, is, you know, step one is 20% is a phenomenal return. It works because it's a formula and it's completely repeatable. But you know, the first thing everyone wants to get comfortable with is, people I give my money to, are they going to steal my money, right? So that's number one. Then number two, is my capital protected, right? How do I protect my capital? Then number three, I have my capital protected. Am I going to get a good rate of return? And what has to happen to make sure I get a good rate of return? And then what has to happen to get a really, really good rate of return? So, you know, I think hopefully by explaining tonight kind of the inner workings of what we do, that lets you kind of walk through the whole program. So again, this particular property projects an annual average return of 18%, annualized return, and targeted cash flows of 4 to 6. And you know, as Bob will tell you, when you see the executive summary on every deal is virtually identical, because we're doing the same thing. We're not suddenly buying a different building. We're buying a building, we're in the markets we like, and we're finding the same type of building to do over and over. So that's the presentation, and I'm certainly happy to answer any questions.
If you're in the deal for, let's say you're in the deal for 2 years and you need to get out of the deal.
And you know, we're borrowing at such low interest rate today that we want to replace that. We're driving the cash flow higher. We want to replace that equity with debt, and then you know end up where you know each investor has a nice chunk of money invested that they pulled their money out and gone and invested it somewhere else.
Okay, so Dave, you sold 30 buildings, best deal?
The whole chart is there and the track record's there. You know, the best one, not the best one, there's probably 10 of them that were in the 50% per annum range. So, I mean, the better question is the worst one.
Which is my next
Yeah.
question, which is what's the worst deal?
So the worst one, we've had 3 that were below 15, and the lowest one was 11% annual return, right? So, and the one that was 11, you know, each one of the ones that was below had a story, and the one that was 11, we bought a building in the air conditioner. These all have, you know, decentralized air conditioning. This one building we bought had a big chiller with a single air conditioner, and on June 15th in Phoenix, the air conditioner went out, and the building went to like 20% vacant, you know, went 20% vacant, and it, you know, by the time we got it fixed in September, you know, the air conditioning company couldn't promise us that it was fixed, but they didn't know what it was going to operate like the following year. So an offer came along, made people 11% on their money, and we said, we're going to take the offer. We're not going to risk not taking that offer. And so we sold the building. People got 11% on their money. They rolled into another deal, and you know, and those deals are all performing very, very well. So, yeah.
So these markets you're buying into are very low unemployment, influx of people. How do you find, I speak from experience here, how do you find skilled trades in those markets with quality jobs?
Yeah, that's-
I mean, it's a great question. So we have a full-time guy. We have a full-time guy who oversees our Gold Star renovations and all of our renovation programs. So to give you an idea, last year we renovated 1,088 units last year across 50 buildings. Last month we renovated 288.
So how does one guy get all of those?
Well, he's got teams. So he's got a team in Dallas, a team in Houston. He's actually got 3 teams in Houston, 2 teams in Dallas. So he's got teams, and it's, you know, I mean, I'll tell you, it's not an easy process. But again, the other thing that keeps it easier is we don't sit in very many design meetings anymore where we talk about what we're going to do. You know, and so we're not stuck with a whole bunch of inventory because we bought too many rounded towel bars, because we buy the same towel bar, and if we have too many in one, we just move it to another property.
So we have one more question. What's your typical cost per door right now in those markets, in the Texas market?
To buy?
Yeah.
So Houston, so there's, on average, it's call it $115,000 a unit. It's renting for about $850 to $900 a month. That's our typical going-in price. That's the other reason that I really like the model, is because the rent to purchase price ratio is really, really good. Now, we just bought one in Las Colinas in Dallas. The average price was $150,000 a unit, but it's the nicest neighborhood in Dallas, and we're getting $265 rent increases every time we turn a unit. So, you know, again, we'll pay a little bit more if we're in the right market, but, you know, the model is the same. 1985 building. Hopefully the owners don't live there. We just bought a building in Houston. The owner's from Korea. Hasn't been to the building in 7 years. So, I mean, literally, I don't even have to go and visit the building. We went and looked at it, but if you tell me the owner hasn't been there in 7 years, I'll tell you, we're gonna make a killing on that deal, right? Because, you know, and you know in the multifamily business, putting your trust in a property manager without being on site every week or every 10 days is misguided trust. It's just not. Yeah, so again, and we have 5 different property managers we use. We have a VP of asset management who was with Greystar, and he managed a portfolio for 20 years of 32,000 units. And he has 4 asset managers that report to him, and each of those 4 asset managers oversee 10 properties. Yeah.
Can this be held within your RSP?
Not easily, but there are a couple of ways you can do it within your RSP, but generally not easy. Yeah. Most people are doing this, just companies, or you have to file a U.S. tax return. Costs a couple $100 a year. We assist with the filing. We connect you with the accounting firm that does them. So it goes pretty smooth. Yeah.
Could you hold that in an individual pension plan or a personal pension plan?
That would be a better conversation.
Actually, JP's asking, he's the expert. So what's the answer?
The answer is yes.
Yeah.
So over 30% would be tax sheltered.
Mhm.
Sorry, I didn't hear the question.
He answered your question,
In
he
a
said yes, and you can do a
It was a
self-directed.
planted question.
Yeah,
right?
and that's his business.
Yeah, but you can put it in IPP, or JP's an expert at personal pension plans, PPPs. And there's a lot of benefits of using a PPP that people don't really understand and know yet. So somebody comes up, another question?
Yeah, and I'm careful to answer that, because through a company like Wealth Stewards, they have certain products on their shelf that I don't know which ones are RSP eligible and how they would fit our product, but the majority of our investors you can use. In the States, people come in with 401ks. U.S. investors, Canadian investors, international investors. We have a structure where all the Canadians invest through a Canadian limited partnership, and all the Americans and the international investors invest through a U.S. limited partnership, and they all funnel down into the property level, which is a U.S. limited partnership. So at the end of every year, all the tax, all the losses flow up to each individual.
question in the back.
Yeah.
Sorry, just follow up on the, so the major cost pressure landlords have up here is utilities. We're seeing high single-digit rates of growth in that expenditure line, and you generally can't pass it back. You can, but it's very difficult. Can you comment on the utility picture and the markets you're going in? Like, are there things you do to hedge, or are the markets just, are the utility providers much more stable than they are up here?
It's very sophisticated. It's called RUBS, and you're allowed to basically pass back 95% of your electricity and your water is on top of your rent, and it fluctuates, and you're allowed to adjust it quarterly. So if all of a sudden you're going to get a pop in your water or your electricity rates, you pass it on through. But you know, when you see a property like this, I can't tell you how many we buy where where all of a sudden, you know, in our normalizing of our rents, where we're adding to our NOI, we'll buy a building from an owner where they'll be charging $700 rent for a one-bedroom, and the additional that they should be charging for the electricity and the water is zero. So we'll buy the building. 60 days after we take ownership, we start implementing all new leases, and we add RUBS to it. So now you're charging $40, $50, $60 a month for water and electricity. So again, that's typically in one of our deals, that's where we'll underwrite it. I mean, this space of ownership of the people that own the buildings is quite unsophisticated. So, you know, so when we're buying these buildings, you know, and again, we're usually in the loop because we're very well connected with the brokers. You know, we've become the second largest multifamily owner in Phoenix. So when someone has a deal and they want someone that will act quickly, they'll call us. So very typically, if we're bidding against a large institution, they'll go in and they'll say, yeah, we'll write an offer, but it's subject to our executive committee, our board of directors, and all these different things. We'll go in and we'll say, we'll do 11 days of due diligence. At the end of 11 days, we'll write you $1 million non-refundable check, and we'll close in 30 days. So it doesn't really matter what our price is. That's certain, and I don't mean that, like, price obviously matters, but we win a lot of deals where we're not the highest price, but we've got the cash, we're quick to close, and we're nimble. So that's been a big part of the chunk, and so the brokers know that. And perfect scenario for us is they introduce us to, you know, two parties. Usually they're living in different cities. They need to put more money into the building to fix up units. One guy wants to put more money in and the other person doesn't, so they're not getting along. And so the brokers now, he's trying to get a fast deal done, so they'll come to us and say, you know, would you guys put up a big deposit, short due diligence, and I think I can get you a deal done. So that's very, very common for us.
Right, so one of the problems with private debt and private equity deals is that you put your money in and then you hear nothing back, right? That's a big problem. You know, maybe a year later, you'll get a report that says this project's going pretty well. And I think this is one of the things that, you know, so how many of you are accountants? We have some accountants in here? Yeah. So, you know, one of the things that you want is you want to see the numbers, right? So Dave, just speak to that for a second. What kind of reporting do the investors
Yeah,
get?
no, great question. So we have 1,200 investors. We have a portal that's password access. So every single month on every property that you invest in, we put the financial statements up there every month. Every time, so when we take over the building, we do a photo collage, plus all the highlights of the takeover. We do a quarterly report on the building. We do an annual report. We do an annual video report with the asset manager. Because, I mean, if you think about it, all of our business comes because you say, hey, I really like this, and once you're in 2 or 3 of them. And, you know, the craziest thing, so we put this on the portal, we put the monthly financial statements, and with the best of intents, 86% of you will never go and look at the financial statements, okay? But you will, and when you do, you'll be sitting around suddenly telling 5 of your clients who already invested, wow, have you seen the numbers at month 6 on this deal down in Phoenix? And they'll go, no, what are they? And you'll tell them, and then all of a sudden, everybody tells their friends, and then they start going on the portal. So you know, we've been doing this for a long time, and we know that, you know, the 2 kings in this equation are we've got to take good care of the residents, we've got to make the places that they're living really good. And then we've got to take care of the investors, and the way to do that is with transparency and with providing good information, right? Because you can come in, you can invest in one of these for $25,000 US. So it's not like, people say, oh, I thought that, I had to come in and put 150,000 down. No, you can come in for $25,000 US. You can get comfortable with the process, watch the portal, decide if you like it, and then if you decide you like it, then most people come across several deals.
So if we're investing, are we investing in the next project that becomes available, or each thing comes up and
No,
we make
the next one coming available. So call it another 7 days from now. We're going to launch another deal, and it looks like it'll be in Dallas. So we do a webinar launch, we send out the executive summary, but our experience is that we do a lot of events like this because people need time to kind of think about it, digest it, figure it all out. So this is a good opportunity. And then some people look at the very first one, take some time to acclimatize it. Some people are ready to go right away. Other people then look at the next one, compare it to the first one. So it's really just about whatever each person needs to do to get comfortable with the process.
Yeah. So as I said in my opening remarks, phase number 1 is understanding the concept. Okay? So that's what we're here tonight about. When in 7 days a new property is released, if you're interested, we'll go to you and say, hey, there's a property in Dallas. Here, here's a video you can watch, here's all the details of it. You can then decide which one you want to be in. You don't have to grab the first one. Also what you want to do is you want to diversify, right? So you probably don't want to buy all your properties in Phoenix. You probably want to buy one in Phoenix, one in Houston, one in Dallas. Maybe one shows up in Atlanta. Then you top up one of the other markets, right? So what we try to do is we try to determine how much money you want to invest into this concept, and then we'll work with you as investors to put a plan together which will give you a pretty good mix of the products. Maybe we'll get some big buildings, 500 unit buildings. Maybe we'll get some 200 unit buildings. We'll try to avoid 2 buildings right next to each other because you might as well put all your money in one. So we'll work with you to have that plan that works that way. And one of the advantages of working with Wealth Stewards is because they're discretionary managers, you can sign a discretionary agreement, but still we'll walk you through and talk to you about things, but then you don't have to do all the paperwork. We'll do the paperwork for you. You just write a check or we'll pull it out of your account. So, there is a process that we follow, and our process is still, we're still fairly new working with Dave and with Tim here. But we're going to walk you through, we're going to discuss every one with you. We'll sit through the videos with you and make sure that you understand what's going on. Mm-hmm.
Yeah.
Sorry, one more question. So do you have an anticipated rate of return for each project that you invest in, or is it
Correct.
you say, look, this is the average?
Correct.
Yeah.
They pretty much all fit so my partner Janet's a computer scientist, and she basically runs them through the model, and in her mind, they're black or they're white. They fit the model or they don't fit the model. The model is 17-18% annual return. You get 50% of your money back year 2, 75, 100%. Now there may be an occasional one that doesn't quite fit that, and there might be something about it that's just really compelling that we'll then all talk about. But that's really the model. If you look at all 68 deals, and then it's just hey, this one's in Houston. It's right near the MD Anderson. Right? So, the largest medical facility in the world. Like, it just went overnight. Why? Because we have one group in Vancouver that's 25 doctors, and they normally do $50,000 or $100,000 a deal. They said MD Anderson, they all went to 200,000 on that deal. So it's you get these anomalies because of everyone's background, not because of the deal. But generally, the webinars do a good job because you get to listen, you get to ask your questions, you get to find out. I mean, Bob's been on a couple of trips. We're going to organize another trip. We'll probably get 15, 20 people here in the next, probably in January, do another trip and just, again, it's go down on a Saturday, get in a bus, tour around, see the properties, hear about the local market, talk to the property managers. Because again, it's when you really see it live, it's different than buying a stock, right? There's a certain kind of emotional involvement in it that's very cool. You wanna, you know, you see a building and you go, I really like this one more than I like that one, and I'm not sure that anyone's right or wrong about it, because
Yeah, but these places are amazing. Right, Craig went on the tour with me, right, Craig? Where you are? Yeah, like they're, you know, these places look like resorts. They've got, some of them have beach volleyball courts, they have bocce courts, they've got barbecues out there so people can go out and do their barbecuing in a common area. You know, every suite has a specific fragrance, so that when you walk into the main office, there's the fragrance when you walk into the suite. The demonstration suite smells exactly the same.
Mango Tango.
But it's not. I heard they changed it.
Yeah, we did change
Yeah,
it, but I don't
Mango
remember the name
Oh,
of
wait,
the new
we should
one.
just call it Mango Tango. So yeah, so it really is quite interesting, and one of the most interesting things.
We sell it as aftershave too.
Yeah.
Sorry, you had another question?
Yeah.
Yeah, one last question. Don't take this the wrong way. So Western Wealth is a private health company.
Yes.
So what are the sort of checks and controls around what, management's going to take out of this, and what the marketing expenses layered on top of the actual raw investment?
Yeah, very, very clearly outlined in every one of the executive summaries. We charge a 1% acquisition fee on the purchase price of the asset. There's a capital raise fee that goes to the outside EMD firms. And we share in 35%. There's a few other fees, but each one of them is outlined in detail. There's a page 8 in every executive summary. And we're very, very specific. And I'm going to tell you, I don't think those fees have changed in 40 deals, because we have so many clients that the idea that we'd ever change the fees and have to go and tell everybody the new fees, it just makes it not worthwhile. So we've kind of held to the same fees for quite a long time. But interesting is we get 35% of the profit, but we don't share in any of the profit until you've gotten back 100% of your money. Okay? So until you've refinanced and pulled out all your money. Now a lot of people will do what we do, and they'll take a 30% or a 25%, so they'll take less, but they'll start taking it day one. So when you get your 5 or 5% annual return, they take 25 or 30% of that. We don't do that. We don't share in anything until you get 100% of your capital return. So that highly motivates us to get the value up, to refinance, to get you back your money, because then at that point we start participating. Yeah.
One more question.
Yeah.
Typical accountant pessimistic question. You return the equity, the banks come calling because unfortunately NOI dropped or some crisis happened. What happens?
So in the US, there's no personal guarantees on the loans. Okay, so there's what's called bad boy guarantees. So Janet and I sign. She's a female, so I guess it's not really a bad boy, but but it's called a bad boy. So if we did anything fraudulent or environmentally offside, we're personally on the hook for the loan. But besides that, they're non-recourse loans. So at the point, if the NOI, you're not in a situation where these are typically 10-year mortgages. So I guess you're not in a situation where along the way you would have to you'd have to refinance, get it, like you'd have to requalify for a loan. But I guess you could be at a situation in 10 years down the road, which wouldn't make that much sense because you'd have paid the loan down by quite a lot by then. But let's say you're 10 years down the road and the NOI drops and you can't refinance. Then at that point we would have to go back to the limited partners and say, do you want to put more capital in? Or we would say, if you don't want to put more capital in, we have another source of capital that's going to come in, and then investors could either participate as limited partners or with that new source of capital, or not at all. And if they didn't participate at all, then down the road they'd be diluted.
And in those situations, to use a registered agent for those kind of proxies, those vote tallies, like if it come down to a vote.
Oh yeah, no. There's a whole process in the limited partnership as to how we would have to do that.
Okay, Dave, you
Good
wore
question.
No, you wore them out. Yeah. Well, thank you very much for coming out, and
Yeah.
thanks to everybody for joining us this evening in our little due diligence conference. Full transparency is a good thing.
Yeah.
I think Dave told you everything he knows, and now he's exhausted, so we'll say
Well, what you really want to meet is Janet. I tell everyone, she's the brains, I'm just the good looks. But then you meet Janet and you realize I'm neither, so. She's actually, we're in town, because tomorrow night, she just won the 40 under 40 Entrepreneur for Canada. So Caldwell Partners has the big award dinner tomorrow night, so we're all, got our whole team here in town, so quite a deal. She's a real powerhouse, she's very impressive. Yeah.
Just wanted to add for the benefit of everyone, we do have your email, so we will send out a soft copy, so you can have that. And there's a couple of brochures here that are hard copy, but not enough for everyone, so rest assured, we will send you soft copies in your email, and you can feel free to peruse that on your own time.
Yeah, and with printed materials, as soon as you print it, it's outdated. So if you just like to flip through hard copy, you can use that. We'll send you an updated one with updated numbers, where it'll go from 1.2 billion to 1.8 billion, I think.
Yeah, and the other thing I would encourage you, if you're interested, and interested doesn't mean that, hey, you know, Bob or Craig, I'm interested, it doesn't mean you're committed to the next deal, but if you're interested, what I would do is I would let them know, because, you know, one of the things is that when these come out, sometimes they fill like so fast, and people are like, well, and so, you know, and I'll say, Bob, you know, what's the allocation you want? And so typically, you know, what we'll do is we'll have a conversation. Bob will say, look, I've talked to this many people. I think I want an allocation of X number of dollars. Now, that doesn't mean he's going to get that allocation, but at least then he knows he's going to start contacting the 4 or 5 or 6 or 8 or 10 people that have said, hey, I'm quite interested. So the only reason I say it, it's not a sales pitch. It's more just, if you want the right to say no first, then your best bet is to let Bob and Craig and go, hey, I'm interested. The next one that comes around, I'd like to take a hard look. It's not saying that you're in. It's just those are going to be the people that get talked to first.
Right, soft guarantee, if you're on our list as somebody who's interested, you will hear about it within 48 hours of the deal being launched. And I only say 48 because I really mean 24. But I don't want to promise 24, just in case something's up. But yeah, you know, we want to, you know, one of the differences is, you know, we've been in the investment business. I've been in the business for 40 years. And we're used to things that come and go quickly. So, you know, we know that there's urgency. If there's a good deal, we want you to know about it. We want you to be on the list. If you opt out and call us back 4 days later, it might be available, we'll put you in. If it's not available, we'll get you next time. You know, if you miss it, was it Bay Bloor Electronics? You know, our sale's on. If you miss it, you miss it. Right? But there'll be another one coming. There'll be another one coming next month. Another one coming next month.
So I feel a little dirty now.
Yep.
Well, thank you very much.
Yeah, thank you.
And we're around drinking water, so if you guys have any other questions,